Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So recently I've been getting loads of emails and requests from brothers and sisters who are completely and utterly new to the stock market. You know, they've been asking exactly what should I do, where should I start, you know, like what's the first thing you've done. And as always, I'm not a financial advisor, but what I try to do is just kind of give you my basically advice based on what I've done. So explain my journey to you guys rather than just saying go away and buy this or do that. So first thing I normally do when I speak to these brothers and sisters is just to say, okay, do you know why you want to invest in the stock market? How much money can you put into the market? And then we talk about the brokerage and so on. So what I want to do today is kind of give you that information. Okay, so if you're completely new, this is for you. If you're still, you know, you've been investing for a few years or so, then you might also get some value out of these videos. So there's two parts. Today's video, I'm going to focus on 15 different companies that you could potentially use to start in a portfolio, as well as ETFs. And the next video will also be just ETFs, and we'll wrap things up on that one as well. But before we do that, I just want to kind of give you the overview, you know, some of the information. As you can see here, this is the S&P 500. These are the 500 biggest companies in the United States. We cannot invest in this ETF as it is. So the ETF is called SPY. We cannot invest it because it includes companies that sell weapons and, you know, all sorts of rubbish. So for that reason, we have to find Sharia compliant ETFs. There are, you know, the ulama out there, the scholars out there that have got way more knowledge than I do, that have worked with these companies to kind of extract from the S&P 500 some of the best companies and created an ETF. And an ETF is a basket of stocks, okay, from, I don't know, 100 to 500 or whatever, you know, different companies. So it's a very well diversified. And also you can buy individual stocks based on the Sharia compliant, you know, standards or criteria, if you like, and which I will show you in a second. So genuinely, like, I've been getting loads of emails, can I invest in VOO or SPY or whatever? We cannot do that because they includes companies that sell weapons, companies that sell pork, and all the things that we cannot invest in, okay, as that's not Sharia compliant. So that's the first thing I wanted to say. And as you can see, is actually the S&P 500 has done well. So if you look at the last 5 years, 80%. So think about this. Imagine if you bought this ETF, okay, I'm not saying you it's halal, by the way, I'm just saying generally to kind of give you the bigger picture. Because I was having a conversation with a brother recently, and we were talking about properties, which actually, by the way, I've got a couple of news coming up, inshallah. I'm going to share that with you guys at some point. But we're talking about properties, and we're talking about return on investment. So we're talking about like what you will get, the yield, the return, basically. So I was saying to him, you know, you can get like 6%, 7%. And he was like, what, like, can you explain what that means? Is that a good thing? Think about this, right? You leave your money. So imagine if you've got £100,000 sitting in the bank right now, right? And you're not doing anything with it. In a few years down the line, because of inflation, it will be worth less. Because the cost of goods or whatever has gone up, your value of your money, it kind of depreciated. So for that reason, wouldn't it be better for the last 5 years, if you put all that money into this S&P 500, you would have made 80% on top of the money that you've actually put in? Isn't it that better than actually? So I just need you to think of that way, okay? Just think about this way when you're doing, basically when you think about the stock market. Now, on average, the S&P 500, okay, that includes all sorts of mad stuff, has returned about 10%. Inflation adjusted, almost about 8%, including dividends, okay? So if you adjust for inflation, for the 30-year average, the market returns, including dividends, 7.78%, which is really, really good, okay? So now what that means is you've been getting 8% on your money every single year for the last whatever years. Isn't it that a good thing? Instead of losing. So if inflation is 2%, this one is actually adjusted for inflation. But even just if you have not adjusted for inflation, imagine inflation is 3%, you're making 7%. happy days. You're still, making 4%, or even if you adjust it for inflation. So the point I'm trying to make is, investing in something is better than your money sitting in an account. I promise you, I don't have that much money lying around. All I have is my emergency fund, and then I invest everything else. I'm investing in properties, I'm investing in the stock market, I'm investing in businesses that family members own. I'm doing everything I can. I'm always stretching in a way. Right now, we're in a summer, I've had a couple of holidays here and there. Genuinely, I'm broke, right, when you look at my account. But alhamdulillah, I know I'm fine because I have investment just in case I need, anything. I've got this thing here. Alhamdulillah. I've got another portfolio over closer to £10,000 or whatever it is. So I've got money somewhere, but this is it. I just need you to start changing your mindset when it comes to this thing. And of course, there will be years, some of you will be like, okay, can you guarantee that I will get that 7% every single year? No, it doesn't work that way. Look at this. The S&P 500 has returned this much every single year since 1928. So 1928 it was up 37%. 1929 it was down 11%. The year after 28%. The year after 47%. The year after 15%. Can you handle this? Imagine for 4 years in a row you're losing money. Can you handle that? If your answer is no, switch this off. Go away and do what you need to do. If the answer is yes, because on average, meaning a period of time, so 10 years, 15 years, 20 years, 13 years, we're looking about 7 to 8%, 7 to 10% total return on your investment, then stay on, keep watching this video. Because on average, no matter what happens, we'll have down years and up years. Last 2021, we were up 26%. The year after 2022, a lot of brothers that I know sold their stocks that year. They literally sold out. That was the year that I was buying quite a lot. I wish I bought more tech companies because they were the ones that were tanking, right? There were companies like, for example, oil companies were doing really well, but everything else was just going down. I wish I bought more tech companies that year. But I've learned a lot. I've learned a lot since I've started investing. But you now need to think about the bigger picture. The bigger picture is you might make 28% or 16%, 26%, but you will also lose 20% in the following year and then bounce back again. But on average, this is what we're looking for, basically 7 to 10%. Now you know that. Let's now look at the stocks that I want to talk about today and the ETFs for you to start in a new investment, inshallah. And I hope no matter what happens, you need to change your mindset about, can I get 7% every single year guaranteed? No, that it doesn't work that way. Can I buy this stock and if it goes down, can I sell it? Or, you don't need to do any of that. Buy and hold for a long term. Buy high quality companies that you know well enough, you've done your research, and buy them when they are cheap. Honestly, buy them when they are cheap. I've talked about that yesterday here. I've talked about in this video yesterday, I talked about 10 wide moat and undervalued stocks basically that you could potentially look at for the month of August. You haven't seen that video? Go and watch that, because what it does is it kind of gives you some companies that you can use to start your research on. So buy them when they're cheap, hold them for a long term. If they pay dividend, reinvest that dividend and live peacefully. What I'm going to do is quickly now go over the 15 stocks quickly, go over the ETFs that I want to talk about today, and then I'm going to share with you guys the returns from these ETFs and the companies we're going to talk about today. So I'm going to do that kind of back test. If we invested £10,000 or dollars, whatever, and we're contributing only 1,000 every single month for 10 years, what would the return be? We'll do that in a second. But before we do that, we've got slow growers, which are companies that are basically, I will say 4 to 10%. Fast growers is slightly higher than that. And cyclicals that go up and down every single year based on the economy, based on what's happening in the world. And what I would suggest is make this, maybe if you're completely new, maybe pick one from each category. 3, 4 stocks, 5 stocks, no more than that. I'm not saying buy all of these companies. What you need to realize is You don't need to own every single one of them. You can own 2 or 3 from each sector or each section, and then create your ETFs as well. Now, so companies like Procter & Gamble, Merck, for example, AstraZeneca, these are well-known companies. These two, you might not know exactly their drugs and whatever, but we know AstraZeneca, based in the United Kingdom, of course, because of COVID and all of that. Colgate, you buy their product every day. TJX is the TK Maxx in the US, in the UK, and so on. They've got loads of different brands. So I went for companies that you kind of maybe you're familiar with. And then the fast growers, slightly high-tech companies. So this one is a networking company. Applied Material is the semiconductor, and then we've got a pharmaceutical company, Eli Lilly, which is involved of the reason when it comes to diabetes products. They also have the weight loss. We've got MasterCard, which is a company that you should definitely know, and CRM or Salesforce, which is a company that is a cloud basically based company. They do a lot of work with basically loads of different companies to make sure that they take care of their customers, if you like. So each one of these companies, this is what they're expecting the earnings to grow every single year moving forward for the next 5 years. And as you can see, some of them are doing really well. This is one off. I think it will bounce back again to 7-8% next year. But as you can see, the earnings are growing, which means the company is basically generating more money. That's all we're interested, right? They might be overvalued right now, so be mindful of that. And then same goes for this one as well. Okay, we got companies that are like 55% growth every single year for the expected. That could easily change, so you have to be mindful of that. And then we've got the valuation side of it. This all comes from Morningstar. So as you can see, these two are fairly valued at the moment. These are very, very expensive, and so on. And then you've got cyclicals, which are businesses, like I said, that depend on the economy and how the economy is doing. Okay, for example, we've got ASML right now. If semiconductors are doing really well, they're making products and everyone is buying new technologies, the technologies are advancing, all of these things, this company will create, basically this company has the products, the machines that are used to create these semiconductors, and that for that reason they will be fine, and so on. And then you got automatic data processing and Lind and so on. So again, these companies are very cyclical. Business goes up and down. Again, 4 out of the 5 is actually fairly valued at the moment. So you could potentially look at these companies or any other companies, but the point I'm trying to make here is not just to go away and buy these companies. It's just to give you an idea. If you have a couple of companies that are like defensive companies, like the Procter & Gambles and Merck's and AstraZeneca's, and all of these companies are consumers kind of staples, consumer discretionary, as well as, of course, healthcare. So it's the stuff that we really need. Right? These are the companies that change in the world, and these are the companies that, of course, they are changing the world. They're doing a lot of amazing job out there. However, they are very cyclical. It depends on the economy. So if you pick 1-2 from each, for example, and then you build that on top of that, you do your ETFs. Let me quickly now show you what the total returns will be for these companies if you invested £10,000 10 years ago. So here we go. We've got 2014 to 2024. We invested £10,000, and every single year we are investing every single year, right? Not every single month. Okay, we can change this, in fact, okay, to months, but I've just left it 1,000. Say you don't have any other money lying around. Okay, so you're just gonna invest. You've invested 10,000 for the year. Okay, that's it. That's what we're doing, and basically inflation adjusted. And is the annualized, of course. Now look at this. These are the companies that we've done. I've done about 7%, 5%, and so on. So there's no reason for this. You can change them as much as you want. But what I'm interested now is, if you invested in these companies 10 years ago, this much money, and you contributed £1,000 every single year, where would you be right now? You would have £44,000 867. That is investing £1,000 every single year and starting initial balance of 10,000. That gives you almost a 30% per annum compound annual growth rate of almost a 30%. The best year you would have had 52%, and the worst year minus 4.7%, because a lot of the companies that we picked are very kind of defensive and technology companies, so we are fine. So look at this. If you can make 30% every single year, you're beating the S&P 500 easily. Okay, now let's have a look at the ETFs, because I don't want to make the video any longer than it needs to be, and I'm going to show you all the ETFs. And as you can see here, we've got the iShares, we've got the Invesco one, we've got the Halal ones, the Wahid ETFs. And each one of them, you can pause the video and have a look at it. But these are the expense ratio. So this is the money that you would be paying. Okay, this is the total return for each one of the ETFs. This is the distribution yield, or dividend if you like. Accumulating means they will get the dividends from the company, reinvest it for you without having to worry about anything. Okay, you do some brokers, you have to invest. When you reinvested that dividend, you have to pay extra money. This one, they do it for you. This one, they do it for you. If you are in the US, you can get the money. I think you can collect that money. If you are in the UK, you have to, basically, it's the only one that's available is the one that accumulation. Okay, the Ummah is not available in the UK, but all of them are available in the UK right now. And as you can see here, this is the companies that are in each one of these ETFs. Now you might be thinking some of these companies might not be Sharia compliant, but what the scholars are saying is you take the entire ETF and then you apply the criteria. So the criteria of business cannot have more than 5% non-compliant business side of things, so the revenue side of the interest bearing debt cannot be more than 30 or 33%, whichever you use. And then interest bearing securities is exactly the same. So they take the entire thing and apply the rules, not just the individual stocks. Okay, so you might have certain individual stocks in here that are maybe closer to not Sharia compliant. If they are like weapons, if they sell pork or pornography, all of that, that's already been filtered out, and that's why you're paying a slightly higher expense ratio. Okay, now before I stop the video, one of the brothers have asked me a question, and it's a very, very good question. And basically his question was, if you're not being the S&P 500 right now, why are you not investing just these ETFs, and just like why do you buy individual stocks if you're not going to be the S&P 500? I have the answer for you guys, and inshallah I will share that with you guys in the next couple of days. Basically I'll share that with you on a video rather than just like answering to him, because I know I've got that question a few times. So I want to answer it. I want to tell you exactly what basically I'm thinking about. Now imagine if you bought this, okay, about the same thing, okay, a few years ago. So 10 years ago, some of them didn't even exist, but let's just say 10 years ago you bought this, and then you contributed again 1,000. All of them are here. I've done 15, 15, 15, 20, and 20 for these two, because these two are very high growth. So Invesco one and Wahid and Halal one, both of them are slightly high growth. So I want to basically my portfolio to grow faster maybe. So 20, 20, and the rest of them are 15. What would happen? 10,000 would have become 14,000. Let's call it about 15,000. That's compounding annual growth rate of about 20%. Okay, the best year you would have got 32%. The worst year you would have made 20%. That's absolutely amazing. Genuinely, I'm telling you right now, that is really good. So if you are new to investing, you've never done any of these things, okay, open up an account in one of the brokerage. You can use my not affiliate link, but think link, wherever. I don't get any shares these days, so you can open it. You get free share when basically you use that link. And if you live in the UK, in European countries, you can get access to trading 212. Use any other brokerage that you have. Maybe you live in the US, use, I don't know, Robinhood or any other platform. Once you've done that, then do your research. Find out whether you want more stocks or more ETFs. Once you've done that, okay, do your research learn about different individual stocks and make sure that you understand how to invest. Don't just follow people blindly, okay? Once you've done all of that, then you can, if you want to, you can join us inshallah in the Patreon account, where you basically pay in about 15p per day and you get access to this ETF tracker. Okay, the ETF trackers, for example, I put the companies that we're talking about today. I basically bought 100 shares of each. I put random prices here, and as you can see, the three that pay dividends, okay, you can see how much you will make if you basically put 100 shares of each. And these two, of course, do not pay dividends in the UK, and you can use this to track your investment, inshallah. Now, like I've always said to you guys, I genuinely appreciate every single one of you out there. I know you know people that have been with me for very, very long time, so I genuinely appreciate a lot of you have been with me for quite some time. But there are 45% of you guys who watch the videos regularly, but I'm not, have not subscribed or open that notification bell to make sure that you don't miss anything. If you could do that, that would be absolutely amazing, because what I'm trying to do here is spread the word out there, talk to as many people as I possibly can about investing in the stock market. I'm human, I will make mistakes, no doubt. Okay, I will make mistakes, I will lose money just like everybody else, but please make sure you're doing your own research, because your money is very important to you. Like, I can lose some money because I know the risk I'm taking, so make sure you know yours, inshallah. I genuinely appreciate every single one of you. Have a wonderful day. Assalamu Alaikum.